I enjoy coming to work every day knowing that clients are depending on me to guide them through whatever financial needs they have.
Every client we have is different. And so it's really about finding out what's really the most important thing per client.
With financial planning, everything is interconnected. So a comprehensive plan means that you're taking care of income needs now, income needs in the intermediate term, and income needs long term. We'll do an asset cycle portfolio. We'll do a risk-alize test. We'll do a life insurance audit or a life insurance review.
And so when we build a deep relationship with our clients, then we can take a step back and then we can look at different options to help them specifically get to their goals. One of the things I feel our job is as advisors is to introduce strategies to clients that maybe they did not know that they were out there. But it's our idea, our job to come out and say, have you ever thought about this?
And the planning it's not always about income, but a lot of it is also about the legacy. So the element of family is very important to us, and it's important to our clients.
Hello, my name is Steve Jablonski, and I'm the host of Financially Speaking with Jeff Bush. Another interesting topic today in which many Americans and many people partake in or participate, and that's common mistakes someone can make if they leave a job with a 401k. And it's been said that there's a little over $7 trillion in 401k savings. That's a lot of money. So with that said,
Is that trillion with a T, Steve? That's a lot of money. Well, this is an important topic here today. In our offices in Pottstown High atop the Security Trust Building on this beautiful spring day as we tape this. This is a very, very important topic because we talk to a lot of people in the course of the planning that we do that have 401ks, and a lot of people want to know what they should do with them when either while they're working or upon retirement. So it's really a key element of what we do. So I'm excited to talk about this today, Steve.
And so when we get into it, someone leaves a job, and kind of mistake number one, they see an opportunity to take the money.
Yes, take the money and run. So we should cue the song, the old song by the Steve Miller Band, "Take the Money and Run," an old song from the '70s. But seriously, what happens in a lot of cases when people leave a job, they simply take the 401k money with them. They'll take a distribution, and that's problematic for a couple of reasons. Number one, it really hampers your ability to save for retirement, which is the reason why you invest in a 401k in the first place. The other problem is, Steve, if you're under the age of 59 and a half, you're not going to only be taxed on this money, you're going to be penalized. You're going to be penalized 10% for a premature withdrawal. So if you're in, let's say you're in a 20% tax bracket, 20% taxes, 10% penalty, 30%. And most people don't think about that when they take the money out. They just take it all and don't withhold anything. And then when they do their taxes on April 15th, they get a great big surprise that they have taxes due. So take the money and run would probably be our strongest message to people that are leaving an employer, that you want to seriously think about keeping that money in some type of qualified plan.
Now, I know we'll get into some options here in a little bit, but what would be a disadvantage, and we see this frequently, of just people leave a job and they kind of forget about their 401k and they just leave it?
Well, Yeah, I mean, sometimes you just forget about it, and it's like, oh, out of sight, out of mind. And the problem with that is, in an old 401k plan, there may be, may have limited choices, and really with 401ks are really good for accumulation vehicles. So they're really set up to accumulate. You get the accumulation, you get the tax deferral, you get the match in a lot of cases. But what you don't get is really, good ongoing management of that account as you get older. Your risk changes. So let's say, just as an example, let's say you're in your 20s and you had money in an old 401k plan, and let's say you invested it into a fairly aggressive strategy because you're 20.
Yep.
And you got 40 years till you're going to take the money out, so you were in a very aggressive strategy. Well, now it's maybe 20 years later, 30 years later, and you look at that old 401k, and the risk doesn't match the risk that where you are right now. So that's one problem. But I'd say it's risk mismatch. It's maybe not the most appropriate place to be in terms of just having an old 401k that might have not the best flexibility as far as options go. So it's generally, a good idea to get that out of there, whether you want to move it into the new 401k plan or whether you want to roll it over into an IRA.
Yep.
But you want to avoid the first mistake that we talked about, and that is take the money and run. So it's at least keeping it in the old plan is better than taking the money and run. But nevertheless, it's probably not the optimum option.
And most of the time, if you passed away when it was in there, you could roll it over to a spouse. But I have seen in a couple circumstances or situations where the plan documents didn't allow for that. So if you're married and you pass away, the spouse had to take a full distribution.
Yeah,
rare.
I think we'll get
yep,
into that
yep.
In one of the later
Yep.
mistakes. But yeah, that is
Okay.
certainly the case.
So let's talk about options to get the money out but not be taxed.
Okay. So that would be mistake number 3, executing a rollover instead of a direct transfer. Now, this is a common mistake, and sometimes, you think, well, this is just nomenclature, but it's really not. So a direct transfer, or I guess a direct rollover,
Correct. Yep.
would mean that you're going from a 401k plan, let's say, to an IRA.
Yep.
Okay, so the money goes from one qualified plan to another qualified plan. And the key here, Steve, is that the check gets made out to the new institution, the new custodian. So let's say it's in your current 401k plan, and let's say you open up an IRA with ABC Retirement Plan. So you want to make sure that the old 401k plan is making out a check to the ABC Retirement Plan, and then that gets coded as a direct
Yep.
rollover and is therefore not taxable. So the mistake is if you take the check made payable directly to you, to the employer, or to the employee, I should say, to the employee. And in that case, what happens is, so let's say you're like, oh, okay, I'm going to take this money and I'm going to open up another IRA account. Mm-hmm. The clock starts ticking once that check is written. There's a 60-day rollover rule. You have 60 days to take that money and put it into your own IRA. So let's say you have $100,000, okay, and you got a check. It's made. You leave your employer. You take a distribution on your 401k. They write you a check. It's made payable to you,
Yep.
and it's for $100,000. You have 60 days to roll that over into a new plan. If you don't, it becomes a taxable event. You have to pay taxes on that entire $100,000 distribution. So there's a couple other problems here, Steve, that I want to highlight. And one is that even if you do roll over that IRA and set up the new account within the 60 days, so you follow all the rules, the old company, your old 401k company, doesn't know what you're going to do when you get the check. So they don't know what your intentions are. So when they go to code the tax distribution form, the 1099, it's coded as a taxable distribution. So now the burden of proof is on you as the investor, that you have to prove that you rolled that over into a new plan. So you have to make sure you have good paperwork here. So we just had this case this week where the exact same thing happened, where we rolled the money over within 60 days. The accountant is calling as they're doing the tax return and says, hey, this is taxable. What happened? And I said, well, we rolled it over into another account, and we proved with the new institution, we proved by documentation of the investment being set up that it was a rollover. So there's additional paperwork that's involved when you roll the money over into a new IRA within that 60-day rule. Mm-hmm. That's one problem. The other problem is that oftentimes when these employers are making this distribution, since they're making the payment directly to you and they don't know that you're going to roll that over, they will withhold taxes.
Yep.
Right? So what do you know what the rate is? Is it 10%?
I'm not sure.
Is it 20%?
I believe it's 20.
It's 20%. Okay. So they're going to withhold some amount. So let's say they're going to withhold 20%. Mm-hmm. So getting back to that example of $100,000, let's say they withhold $20,000, right? So you're taking a distribution for $100,000. If you want to make that up, you want to make a full rollover. Yep. You got to make up that $20,000 because they withheld $20,000 and sent it to the IRS. Yep. And so you have to take that other $20,000. You maybe have to take it out of your savings account, your bank account, and make up the difference. So it's a full rollover.
So the bottom line is, do the direct transfer or direct rollover to the IRA.
The direct is the key. The direct is the key. The key is that you don't take constructive receipt of the money.
Yep.
The 60-day rollover rule is a good option to have. And there was some special circumstances about that case that I was working on that I referred to earlier, why it happened the way it did. But if you can do a direct transfer, don't take constructive receipt of the money, that's the optimum way to do it.
That makes sense. So let's go to number 4, and we can refer back to the company Enron with company stock, and some people just overload because they believe in the company, and other people sometimes the company match would go to the stock.
Yeah, so mistake number 4, the company stock monster. So the problem here is a lot of it is risk, right? So if you retire from a company, let's say it's a big company with stock, and you have a lot of company stock, it's overweighted. It could be overweighted in that stock, right? And you mentioned the company match, and a lot of times the company match will be in stock. So you put your own money in, and you maybe invested in funds that are appropriate for you, and then the company comes along and says, oh, we're going to match your distribution or your contribution with stock. So then what happens is when you go to retire, you're sitting with all this stock, and it may not be the appropriate asset allocation for what you're trying to accomplish at that stage in life. And you mentioned a company called Enron, and for those of you that remember this, and this goes back, we're probably going back about 20 years now with with Enron. So Enron had all these employees, and they were given all these employees stock. So I think, and I don't know all the sort of details, but I know the match was in Enron stock. Were they requiring people to make contributions?
It's been said that they had to keep the Enron stock until they were 55. So their hands were kind of tied.
Well, their hands were tied. Okay, so their hands were tied with the stock, but so was this employee contributions, or were these company matches?
It was company match.
A company match. Okay, so if you left the company, you couldn't take the stock with you. You had to wait until you were 55.
If you were employed, if you were employed, you did. I'm not sure.
If you were
left.
employed,
yeah.
So regardless, the problem is that the stock went belly up.
And I've also seen where someone has stock in their 401k, they buy it at a discount and outside, and they get stock options.
Yeah.
So it's a interesting conversation to have with people.
Yeah, and we've had this conversation a lot with people, and a lot of times you have a lot of allegiance to the company that you're working for, which is fine. But then, at some point you look at, and I won't mention the company's name, but it's a big employer in this area, and we've seen some rather large balances in these retirement accounts, and it's really problematic.
And let's talk about what's called NUA, and we don't see it a lot, but I don't want to get too deep into it. But what should someone know, and kind of be aware if they have highly appreciated stock?
Yeah.
In the 401.
So NUA is net unrealized appreciation. So what NUA does is it gives you the ability to roll that stock, hold the stock and roll it outside of your company 401k plan and into a separate account.
And it's really for people that have had stock for a long time, because it's off the cost basis. So it's something that if someone has old stock in their 401k, before they would cash that in or get out of it, they should come and talk to somebody.
Yeah, because the tax ramification, there could be some tax advantages to using the NUA. Yep. So that's a good point, and that's not something that generally people are aware of, or I should say a lot of people are not aware of it. So we have those conversations from time to time.
Yep. So the next one is really if something should happen as far as a death, what's that look like, and how can people take care of that?
So mistake number 5, failing to properly name beneficiaries. This is an important one for a lot of reasons. So the first reason that I'll give is let's say that you have no beneficiary on your 401k for whatever reason. Normally, when you set up the 401k, they ask you to name a beneficiary. But let's say for record keeping purposes, maybe companies got acquired and records got lost and whatever. I know with computers now, it becomes somewhat less of an issue because there's a trail of beneficiaries. But I know for example, when the attacks of 9/11 happened, there were a lot of records lost in the Twin Towers, and a lot of that was beneficiary type information. But if you die without a named beneficiary on any retirement account, what happens is the money kind of defaults into your estate, right? So it becomes part of your estate. And that's a problem, because then it becomes taxable in the year that you die. So particularly if you have a spouse, because a spouse gets treated just like it was the person who died with respect to the IRA. So you can you can assume that IRA. If you're a named beneficiary, you can roll it over into your own IRA account, and you continue to enjoy all the tax deferral benefits of a qualified plan. So naming the proper beneficiary is really important there, because you want to make sure it gets to the right person and they can enjoy all the tax deferral and the tax efficiencies of a retirement plan. I guess the other problem is, life events. So death, divorce, birth, all those things. So, let's use the example of a divorce, right? So let's say you get divorced and remarried, and you forget to name your new spouse on your 401k plan, right? And you die, and the money goes to your ex-spouse. That may not be what you wanted, right? It's most likely it's not going to be what you wanted. So you want to make sure, and we do beneficiary reviews, so we make sure that all these beneficiary designations are up to date. But you want to make sure that if you get remarried, you name your new spouse. If you get, sometimes it's easier if your spouse dies, right? Maybe you want to take your spouse off, your deceased spouse off, and put your children on, or someone else. And usually you have contingent beneficiaries on these designations. So what a contingent beneficiary does is, so you have a primary beneficiary. So let's say, Steve, you have a 401k plan and you name your wife as the primary beneficiary, and then you name your children as contingent beneficiaries. So what that means is, if your wife dies and you don't get around to changing the beneficiary designation, then upon your passing, the beneficiaries would then be your children. They would step in and become the beneficiaries to this account. One of the issues that we see with that is that there's some additional paperwork that's needed, because let's say your children go to make this claim, they don't only have to prove your death, they have to prove the death of your spouse, who may have died many, many years ago, right? So we want to make sure we're clean there and have current beneficiaries. I think before we move on here, Steve, we should mention a few things about our firm and how people can get a hold of us. So we have, we'll list our contact information. If you want any more information on today's show, whether it's mistakes that you make with a 401k or anything else. The other thing I want to mention is that we're going to be doing a live event coming up. We actually have two of them, so we'll put that information on the screen. We haven't done live events for a while, so we're going to be taking the show on the road. We're not all about just being here inside this office here doing the show on PCTV, but if you want to come out to one of our events, call our office for tickets. And I should also mention that we're here on PCTV, so you can see our show not only on the TV station, but you can also view it on the PCTVnetwork.com, as well as our website, which is informedfamily.com.
Good. That's a good information. Before we move on to number 6, Jeff, let's educate people on a named beneficiary versus a will. How does that, what is that?
Okay.
You have a will, but
the named beneficiary takes precedence over a will. So that's one important factor, because a lot of times people don't know that. They'll think that, I have a will, that covers everything. Any designation that you have on a retirement account, this also holds true for an annuity or a life insurance policy, where you have a designated beneficiary. That's who's going to receive the money. It's going to take a precedence over what you have in your will.
It's very important. So let's go to 6 here, and we see this a lot in volatile markets.
We do. Mistake number 6 is trying to recoup losses or change performance. So that simply means that if you have a bad, let's say you have a bad year and you lost money, and now you're gonna change your risk because you want to get aggressive and you want to try to make it up. It's kind of like the gambler, right, who loses money at the blackjack table and wants to
double down.
So he just lost $10 on the blackjack table. So now he's going to bet $20, right? So it doesn't really, your chances of winning don't get better because you just lost the first game, right? So it's the same thing here. Your chances of winning aren't going to be any better.
Yep.
So you don't want to. You want to stay the course, is what I guess what we're saying here with
Yep.
mistake number 6.
Yep. And then a lot of people, they just don't think about anything else. They have the 401k, but they don't really know the impact of the savings and how that's going to help them in retirement.
Yeah. So bury your head in the sand about retirement. I mean, that is simply put is set it and forget it. You're just putting money into a 401k plan. You're not paying any attention to it, and it's simply, you simply bury your head. You don't look at the allocation. You don't look at the risk, and these things need to be monitored because it's a significant part of your portfolio in many cases. So you don't want to bury your head in the sand. So with all that being said, Steve, great show today. Went through all the mistakes that you don't want to make with your 401k. If you want more information on this very important white paper that we did with all these mistakes, make sure you contact our office. This is Financially Speaking.